Here are my top 10 stocks to buy right now, half of which I actually invest in my personal portfolio. In this video, I'm going to first be showing one stock that I own, followed by one stock that I don't yet own, and working my way up to my highest conviction positions overall. So hopefully this list gives you a jumping off point to do some of your own research on these companies. But to start off with, to show that I'm not just pretending here, here's my actual stock portfolio and how it's performed over the year. We can see that over the past year, it's actually lost money, which makes sense. There's been a massive sell-off in tech stocks that I'm heavily invested in. But if we look at it year to date, I actually have a year to date return of around 15%. And to reach that 15%, my portfolio has been down and up and down and back up again, which is kind of just par for the course when you're investing in high growth tech stocks that tend to be pretty volatile. So first, let's start off with a stock that I don't yet own but has a ton of potential to grow in the future, and that stock is Microsoft. Now, Microsoft has obviously been in the news recently due to their close relationship with OpenAI and their incredibly smart investment in the company early on. But while as recently as a month ago, everybody was talking about how OpenAI and Microsoft would completely change the world with ChatGPT and large language models, now it almost seems like the discussion has swung the other way, where people used to be overestimating ChatGPT, and now it almost seems like they're underestimating it. So there's three main areas that I think Microsoft has a lot of potential to grow with using its relationship with OpenAI. The first is Microsoft Office. On March 16th, Microsoft announced Microsoft 365 Copilot, which was supposed to be an AI-connected workspace that would connect all of your enterprise apps together. You could talk to it and it would generate a PowerPoint for you. You could take notes on a meeting and then convert those notes into a presentation. You could watch a presentation and just get a summary of the most important points. The productivity boost from this, which is already one of Microsoft's most successful products and the most used Office suite in the world, could be massive for Microsoft, especially as their focus seems to be more and more on enterprise customers rather than just consumers. And while you could say, sure, everything these AIs can do, I could also do, but the most important thing here is how much it improves productivity of workers. If a worker could save an hour making a PowerPoint, or save 30 minutes by rescheduling all the meetings in their Outlook calendar to align better with everyone else's schedule, those small increments add up. If you're paying someone $50 an hour, or in Microsoft's case, probably $100 an hour, saving a couple hours a day is a lot of money. And companies will be willing to pay a premium for this, or more realistically, they'll be willing to switch over from cheaper apps like Google Docs over to Microsoft specifically for this kind of functionality. The second area that Microsoft will benefit from is through development. Microsoft has already been a platform of choice for many developers, and their acquisition of GitHub a few years ago really cemented their status here. In fact, Microsoft's Copilot for Office 365 seems to be named after GitHub Copilot, which is an AI tool that helps developers code more efficiently and more quickly. Most of the time spent developing is spent doing one of two things: generating boilerplate code or debugging issues. If you can have an AI that can help you in either of these two areas, it can save you a ton of time and let you focus on the actual important parts of creating new things. Pair this with Microsoft's VS Code platform, which is an IDE that lets you develop on Windows machines as well as Macs, and you have a very powerful combination. Microsoft is also working hard to get these two systems more tightly integrated into Microsoft Azure, which also happens to be the third area of focus for this company. When it comes to enterprises building applications, there's pretty much only three options. You can host it yourself on your own servers, you can put it on Amazon Web Services, or you can put it on Microsoft Azure. Some people are using other cloud solutions, but those are really the big three. And Microsoft Azure has taken a huge leap forward recently. Right now, AI is in the news everywhere, and it's at the top of mind for many CEOs and executives, and they want to start building apps that have AI incorporated with it. But in order to build those apps, they need to host it somewhere. Well, because of Microsoft's partnership with OpenAI, Azure has their own OpenAI service where they can actually provide these services that integrate directly with companies' apps that are hosted in the cloud. And if companies are already going to use Azure for that, they'll probably build their entire infrastructure on top of Azure as well. Now, there is some competition in this space from Google's Bard and Google Cloud, or AWS also has some AI services, but it's pretty much unanimously agreed that what OpenAI has developed is the best solution for large language models. Now, while I think this is great news for Microsoft, I don't expect it to show up in their earnings in the short term. Realistically, Microsoft is spending more money right now on pushing the AI to their customers than they're going to get back from it. But what's more important here is the strategic positioning, because as companies start to try out Azure services or try out Microsoft Word, or even start their development in GitHub, once they're in there, people don't tend to switch away from those types of applications. So just getting people in the door can be a win all on its own. Next, we have the first stock that I invest in personally. And make sure you watch until the end, because at the end of the video, I'll be showing me my one largest position where I invest 25% of my individual stock portfolio. So my first stock position is SoFi, which is a bank bank that's attempting to cater to millennials and Gen Z and invent the future of banking. SoFi is really three businesses in one. You have their financial services, which is like the SoFi app and the SoFi credit card. This is what they're always advertising on TV and on TikTok. You have SoFi lending, where they make the majority of their money. SoFi is the single largest private student loan lender in the world, which hasn't been great recently with the pause on student loans, but they've also moved into other areas like personal loans and mortgages. Then you have all this money getting fed into SoFi's technology platform, which is a combination of acquisitions they've had of Galileo and Technisys. SoFi is building this platform with the intention of becoming the AWS of fintechs. Basically, fintechs can use SoFi's technology to launch their own brands on top of it. So you know how right now every celebrity is launching their own tequila brand or some kind of drink company? Well, with SoFi's platform, it's possible in 10 years people are going to be launching their own banks built on top of SoFi's platform. And with 500 million legacy bank accounts currently up for grabs, SoFi has a massive opportunity to grow here. The company is also pretty fairly valued currently. It's sitting at around $5 billion overall, which isn't that much higher than just the basic worth of their assets right now. So if we account for any level of growth or any strategic positioning from SoFi, this gives them a lot of room to grow their market cap as their revenue increases. The next stock is another company that I do not yet own, but has a really interesting backstory. This company was originally founded by two PhD students at Stanford during a research project. They eventually turned this into a company and received startup funding from the likes of the Sun Microsystems founder as well as Jeff Bezos of Amazon. The company quickly grew from there, eventually IPOing at a market cap of $23 billion in 2004 before continuing to grow until they're now worth 69 times that amount today. Nice. Okay, so that company was Google, but here's why that startup story is relevant to them today. Google, like all the big mega corporations, is effectively a bunch of smaller businesses put together. And one of those businesses is called Google Cloud, where developers can launch applications that are hosted on Google's infrastructure. It's a much more efficient way of building applications than hosting it on your own hardware, and it's the way that most forward-looking companies are moving to today. Google Cloud, in their most recent quarter, reported profit for the first time in their existence, generating $191 million in operating profit after losing a total of $4 billion between 2021 and 2022. That's with a revenue growth rate of 28% from a year ago. And it's really interesting the timing of this reported profit. Now, I just got through telling you how Azure has the best large language models and AI with their integration with OpenAI. But that's only generative AI, and there's a lot of different types of AI. You have generative adversarial networks called GANs. You have more traditional AI. You have all the services that Google has been offering for a really long time. In fact, prior to this announcement of ChatGPT, Google was by far and away the leader in the AI space. Computer vision, voice to text, creating conversations with multi-turns that an agent can talk to you with. All of these were services that Google has been offering in their cloud for quite a while. And now, because OpenAI has thrust AI back into the conversation, that ironically is helping Google. Companies are looking and saying, okay, how can I put AI and ChatGPT into everything? And a lot of the use cases they come up with aren't actually that good of a fit for large language models. So they end up turning to other forms of AI that can meet the actual use case they want, and there's a ton of funding behind it because that's where the hype is right now. It's kind of like how rising tides lift all boats, and it's especially true if your boat has a ton of flotation devices. I don't know if that metaphor really works that well, but the point is, Google has the largest selection of really high quality AI services of any cloud platform out there, even beating Azure. Now, I have no doubt that Azure is going to gain market share, maybe even faster than Google will, but in a market where Amazon Web Services has been the leader this whole time, this new focus on AI is going to benefit Google Cloud and thus Google as an entire company. Next, we have another stock that I own, which is in one of the most important but most overlooked aspects of the tech industry, security. So the next stock that I'll be talking about is Zscaler, which I currently own 30 shares of at a value of $3,800 overall, and that is down off an initial investment of over $8,000, so it's lost more than 50% of what I initially invested in it. Now, you'll see here it has an F rating from Charles Schwab, and so do all the other companies on this list, but that's because Charles Schwab seems to do a value-based investing metric rather than a growth-based one that I tend to go for. One isn't necessarily better than the other, but I will say that in the past I had a company, Crowdstrike, that I invested in, which made me a 300% return over around 2 years, and the entire time I held it, Charles Schwab was rating it as an F, so I don't put too much stock in those ratings. Zscaler is mainly down because it's a growth stock and it's a tech stock, and all those companies have been down over the last year. But what Zscaler does is actually pretty revolutionary, and it's very well positioned. position. See, Zscaler offers zero trust security. If you think of a traditional network, the way they're set up is with a firewall, literally a wall around the entire network of computers that keeps the bad guys out. The problem is, if the bad guys get in, they now have access to your entire network. And those kind of attacks are going to happen more and more, especially as we now have generative AI that can create viruses on the fly. So what Zscaler does is offer zero trust security, where every computer, every application, every person on the network has to authenticate every time they talk to someone else. This makes the network much more secure because if one person's compromised, they can't get out to anybody else. And this is also the way that most cloud applications are now being architected, which means as more companies move into the cloud, that is going to benefit Zscaler. Now, after Zscaler's drop from their peak in November 2021, with the stock down around 65%, they're currently sitting at a market cap of just over $18.5 billion. But that is with revenue of nearly $400 million per quarter while growing at 50% year over year. So basically the thesis here is that Zscaler will maintain their growth longer than the market is expecting, and they will effectively have to grow the market cap because the company will be making so much money. Now at the same time, while the company has a lot of revenue, they're not yet profitable, but their net income is moving in the right direction. A year ago it was at negative 100 million, dropped to 97, dropped to 68, and in their most recent quarter it's at negative 50 million. So as long as they continue this trend, the company should start making money relatively soon. And by the way, stick around until the end of the video to see what trades I've made in the last month. Now next up, we have an incredibly unique stock that may even start to push out some of the FANG companies as one of the most important tech companies in the world. But to get to the point where they are now, they had to start as a small business like everyone else. And like all small businesses, there are some common struggles. This channel kind of runs like a small business. And I know that I personally sometimes struggle with creating unique passwords for every site and memorizing them, or sharing sensitive data like credit card numbers with other people. And that's where this video's sponsor, NordPass Business, comes in. NordPass is a secure way to share passwords. How much time do you spend tracking down, guessing, or resetting passwords? Well, with NordPass for your business, you can store all your account's passwords securely and access them from anywhere, even from on your phone. Instead of sending your sensitive data via instant messaging or email, which is both a major security liability as well as just inefficient, with you needing to wait for them to reply, or messages sometimes just getting lost in the mail. NordPass lets you save confidential information securely in one place, where it can be accessed and updated by others when needed. Or if you're bringing on a new hire or letting someone go and you don't want to spend a whole afternoon setting up their accounts and giving them access to everything, you can easily give them access or remove access with NordPass in just a few moments. And if you're like me and you don't like making new passwords for every website, NordPass has a password generator to create new passwords for you and a password health checker to make sure your confidential information is safe. Plus, it's super easy to sign up. Just go to nordpass.com/fintech and use the code FINTECH at checkout for a 3-month free trial. Now back to that company that could soon replace some of the FANG stocks as the most important tech company in the world. And that company is Nvidia. Now Nvidia has always been a popular stock to talk about online, and it's really no wonder. You have gaming, you have artificial intelligence, you have crypto, you have metaverse. Every single trend that seems to pop up in the online conversation in some way ties back to one company. And that company is Nvidia. We are now entering a new stage of AI, where it's no longer about building bigger and better models for AI, and it's becoming more important that we optimize the models that we have and actually make them smaller and more efficient. That includes improving the software that's using the AI, it includes improving the models themselves, and it also includes improving the hardware that those models are going to run on top of. And no one does that better than Nvidia. Nvidia knows how to ride these waves at this point. They've rebranded themselves as the top result on Google with Nvidia, world leader in artificial intelligence computing. And I guarantee when quantum computing becomes the big thing, they're gonna rebrand themselves in that area. And the thing is, this isn't just branding, it's actually true. Nvidia can do all these different things. And that's partly why Nvidia's stock has grown so much over the last several years. I didn't realize it until I looked at it, but Nvidia is sitting at a market cap of $750 billion. That means that it is now worth more than Facebook, which is currently sitting at a market cap of $640 billion. It also means it's worth more than 5 times Netflix, which is currently sitting at a value of $160 billion. Nvidia isn't a small company anymore. They are a major player in the tech space, and their massive market cap now gives them the opportunity to potentially corner new markets. You have self-driving, you have enterprise cloud, you have software as a service. Nvidia could enter these markets not as a provider of services to them, but as a real competitor in any of the markets. And just due to their sheer size, they would have a major competitive advantage in all of them. Basically, they're in a situation right now where they have have too many opportunities and too little time to pursue them, which is a really good place to be. Now, the next company is a company that I own, which is using AI to supercharge the security software space. Crowdstrike is a cloud-native cybersecurity company that excels at protecting cloud workloads, especially using AI. Their unique threat graph technology allows them to take in data on all the different breaches that have occurred before. But unlike a traditional security company, rather than having to compare new potential viruses to that database, they can layer AI on top of that to proactively recognize viruses and attacks before they happen. And they are doing this better than pretty much anyone else out there. According to Gartner, CrowdStrike is a leader in the Magic Quadrant for endpoint protection platforms. You can see them on the top right here, with a higher completeness of vision than Microsoft and more ability to execute than SentinelOne, Cybereason, Trend, Micro, or Sophos, and putting them miles ahead of companies like Cisco and Palo Alto Networks. CrowdStrike's sitting in a really interesting area where they're benefiting from two trends at once. They're benefiting from the move to the cloud that more companies are still undergoing, plus you just have cloud companies generating new applications for the cloud that need protecting, and they're benefiting from the new advent of AI technologies. We are going to start seeing viruses and attacks that are generated by AI. It's going to happen. If you thought there were a lot of viruses before, there's going to be a lot more in the very short-term future. And the only way to combat that is to combat it with more AI, which puts CrowdStrike in a really good space to potentially take advantage of that opportunity. The company has been a solid grower for several years at this point. A year ago, they made just under $500 million in revenue, and this quarter they made $637 million in revenue, while growing at nearly 50% year over year. This is already a large company, and they're growing that quickly is just a sign of how good their products are and how much their customers love them. Now, we could see some slowdown in security spending if we enter a recession, but at the same time, recessions tend to benefit leaders in a given space while knocking out the other competitors. So we may see some consolidation toward CrowdStrike if we do enter a serious recession. All of these are reasons that I invest in the company. Now, next up is another stock that I don't own, and I'm going to go for a bit of a crazy one here. Now, I'm not going to say that this stock is guaranteed going to make a lot of money in the future, but I am going to lay out the case for why Facebook might have some crazy upside from here. Now, you know Facebook. It's the platform that used to be for college students, which now tends to be for people aged 50 to 70 years old. It's also the company that decided to rebrand their entire thing to Meta Platforms, probably a little bit prematurely according to most people, and it resulted in their market cap dropping around 70% in a matter of months to a current market cap of $640 billion. And that's kind of been the story around Facebook. Everybody's talking about how they made this horrible investment into Meta and they basically killed their company. But I don't think that's necessarily true. If we look at the company's stock price starting at the beginning of the year, the company has increased in value by 175% in roughly the last 6 months. Remember, this is Facebook. The company has nearly tripled in value in 3 months, and nobody seems to be talking about it. To me, this seems to show that the market overreacted to the negative criticism of Meta. Now, yes, Metaverse is obviously not a mature technology, especially from the consumer-facing space, but that was never going to be where Facebook started out. If we look at pretty much any kind of revolutionary technology, it tends to hit the enterprise space first because they can afford more expensive stuff, and they're willing to spend more money to make a little bit more money for themselves. Virtual reality, and I think more interestingly, augmented reality is already starting to have impacts in the enterprise space. Extended reality technologies right now are kind of like BlackBerry back in the day. It's really useful for business users, it's ugly to most consumers, and it's just hinting at the future possibility. Quite frankly, I do not see a future 30 years from now where virtual reality and augmented reality are not much larger markets than they are today. And Facebook has clearly put themselves right in the target for that market, which means they're better positioned than the other tech companies to take advantage of this new trend. Yes, this is going to result in short-term losses because, quite frankly, they need to invest in the technology a lot to get it to the point where most people want to use it. But when I look for a company, I'm looking for stocks that are willing to sacrifice in the short term for a long-term vision, and Facebook seems to be doing that. Now, next we have another stock that I own, and it may be the company that I've talked about more on this channel than any other stock, and that is Cloudflare. Cloudflare, in this account, I currently own 185 shares of at a value of just under $11,000, and that's down a little bit off the initial investment of $13,500, so it's lost just under $3,000 overall. Now, part of that is due to the way that Charles Schwab calculates the gain and loss on a stock. They do first in, first out, and since I bought more Cloudflare when it was more expensive and then sold some at that price, it makes this look more negative than it actually is. But here is why I absolutely love Cloudflare as a company. Cloudflare is working groundbreaking to make the internet itself work better. They started out just hosting websites and offering firewall protection to that website, basically monitoring traffic to keep the bad actors out. But they then realized they're already monitoring all this traffic, so they could also use that data to optimize the web experience for good actors. Since then, they've launched innovation after innovation to the point where now they basically operate their own cloud platform, something that would have basically been unthinkable 10 years ago. Cloudflare now runs their own global network for the cloud where you can run websites, you can run workloads, you can create APIs, you can basically run your entire business on Cloudflare's network. And many of their services are superior to those offered by the large companies like Google, Microsoft, and Amazon. The company is currently sitting at a market cap of just under $20 billion, and they are making around $300 million in revenue per quarter, which comes out to around $1.2 billion per year. Now, Cloudflare has promised that they're going to 5x their revenue over the next 5 years, which might seem kind of crazy, but it actually seems realistic when you look at their past earnings. Cloudflare grew their revenues 36% in their most recent quarter, 41% before that, 47% before that, 53% before that, and they've grown at 50% year over year for basically the last half decade. In fact, if Cloudflare just grows at 30% year over year going forward for the next 5 years, they will hit their 5x goal. Now, if you're going to do any kind of research into Cloudflare, here's where I would recommend you start, with Matthew Prince's blog. He's the CEO of Cloudflare, he's a really good writer, and he does a great job of breaking down seemingly complex topics into ways that are really easy to understand. And now to round out the top 9, we have my single largest stock investment overall. And once you see what this company does, I think you'll see why. That company is Snowflake. Snowflake, I currently own 100 shares of at a value of $18,000, and that's off a cost basis of around $15,500. So it's made $2,500 so far in this account. Now, Snowflake is a data company. If you think back to the early days of data, how did we keep track of it? We probably carved it onto tablets. Then we started writing it in simple notebooks. Then we invented the spreadsheet and started keeping track of basically simple Excel sheets. Then that moved over into databases, offering a 10x improvement in efficiency. Then we had data warehouses, we had data lakes, we had the cloud, each of which was a 10x jump in the efficiency of the use of data. Snowflake is taking that one step further, inventing the data cloud. This is a single platform where companies can pay Snowflake to access their data, share that data with other companies, develop on top of that data, and create new revenue streams using the data that their company is already producing. When I say Snowflake has one of the best products in the world, I'm not exaggerating. We can actually see it in their numbers. Snowflake has a net revenue retention rate of 168%. That means that for every dollar a customer spends this year, Snowflake can expect that same customer to spend $1.68 next year. Customers don't do that on products that don't work and that don't make them more money than they already cost. Plus, Snowflake is just making themselves more and more sticky. They now offer data edges where companies can share their data along an edge. So think pharmaceutical companies collaborating on building a new drug. They're going to share the data for that drug, and if any of the companies were to leave the platform, they would lose access to that collaboration. We're now entering a world where companies are more willing to share data with each other as they realize efficiencies in actually collaborating rather than just competing. And Snowflake makes that possible. Or if you just want to host your own data and do it in a way that's a lot more efficient than hiring a bunch of expensive engineers to manage it for you, Snowflake is a good way to do that too. Now, Snowflake has always been an extremely expensive company. When they IPO'd way back in September 2020 at a price of $240 a share, they were sitting at a higher market cap than they are today. Currently, they're sitting at a market cap of $57 billion, which with revenue of just over $2 billion per year, puts them at a price to sales ratio of 27.5, which is very high for any traditional company. But if we look at Snowflake's price to sales ratio in the past, we can see how much cheaper the stock is now relative to where it was before. If we go back to a year ago, Snowflake often had a price to sales ratio of well over 100. At their peak, they even got close to having a price to sales ratio of 200. But the reason that is so high is because people have such high confidence in the company succeeding and because of their very high growth rate. The company is growing at 50% year over year while making $2 billion in revenue each year. That means next year they would make $3 billion, the year after $4.5 billion, the year after that, $6.5 billion. The numbers get insane very quickly if Snowflake can just maintain a relatively high growth rate. And remember, each customer already spends 68% more each year than they did the year before. So that's a good sign that the growth rate can continue. And if that's not enough, even though Snowflake is a growth stock and a tech stock, Warren Buffett is actually an investor in the company. He owns 6.13 million shares of the stock right now at an average price of $230, which is actually a higher entry point than I currently have. Now, I'm not saying that every stock Warren Buffett invests in is going to go up. But it is nice to see that a conservative value investor like Warren Buffett sees the value in what I'm investing in as a hyper-growth stock. And it does increase my overall conviction in the company. Now, while a lot of the stocks that I invest in are pretty volatile and they are often growing very quickly, I understand that investing can be very risky. And so I always put at least 15% of my income into an index fund before ever touching individual stocks. Also, outside of the stock market, I also put money into real estate to help diversify further. That helps give me a solid base so that I'm not stressing out when these stocks go up 20% and then down 20% the next day. All that is to say, don't copy my stock portfolio because you might have totally different conditions than I'm in. You don't want to be risking your entire life savings on stocks that are this volatile. The only trade that I made this month is I sold around $3,000 worth of my Datadog stock, and I just did that to have some more cash on the sidelines to invest in some other opportunities. So if any of these companies were interesting to you, just let me know in the comments, and also let me know if you think there's some other stocks I should look into. Don't forget to like and subscribe, and I'll see you next time.